If you own crypto or are thinking about buying some, it is vital that you understand how you'll be taxed on it. There are some common questions I get asked all the time, such as, what happens if I switch between coin A and coin B? What happens if I receive an airdrop? And how in the world is crypto staking taxed? Some of you may have seen my How Does Tax Work on Crypto video I dropped a few years ago. In fact, it's the most popular video on my channel. But I asked the community the other day, do you want to see an updated 2023 edition? And the answer was an overwhelming yes. So here I am with a How Does Tax Work on Crypto in Australia 2023 edition. Now, what happens if you move from coin A to coin B? This is the most common question and the most common area of confusion, but at the same time, it is the most important area to have a thorough understanding of how it works. At a basic level, if you sell coin A and you buy coin B, it is a taxing event. You will then be taxed under the capital gain method, so you'll either have a capital gain or a capital loss, and then this will go into your tax return, and then you'll pay tax at your marginal rates. Now, there is no separate capital gains tax rate here in Australia. There is the 50% discount if you hold for over 12 months. So if you do hold that coin and then you switch to another coin after holding it for 12 months, the gain will be cut in half. Now, moving from coin to coin is likely going to be the first taxing event that you will experience, because buying crypto itself isn't a taxing event. It is only when you either receive an income event, which we'll talk about later, or when you dispose of a coin that there's a taxing event. So here's an example, someone who buys one Bitcoin and the current cost of that is $40,000 to them. And a few months go by and they decide they want to buy some Ethereum. So they work out they can buy 15 Ethereum with their one Bitcoin. So they go to their exchange and they execute a trade of one Bitcoin for 15 Ethereum. Now, people get confused here and they think, oh, well, I have just still got crypto. I haven't cashed out to Australian dollars. There's no capital gains. That's not correct. We now have a taxing event here, a capital gains event that we need to work out. And it's simply by working out, well, what is the Australian dollar value now of this trade? So Bitcoin had actually risen in price and it's now worth $50,000 when we do this trade. So we've actually disposed of our Bitcoin for $50,000. Now, we only paid $40,000 for it in the first place. So we've actually got a $10,000 capital gain here. Now we have 15 Ethereum and the cost base for that is the $50,000. So even though we haven't cashed out to Australian dollars, we haven't put anything back in our bank account, we have made a capital gain because the price of Bitcoin when we purchased compared to when we sold has moved, and therefore the gain is calculated on that. Now, where it gets interesting with crypto is people can make thousands of these transactions in a year. I've seen people with 5, 10, 15,000 transactions in a year because they don't realize how many transactions they're actually building up as they're switching between coins. And because it's so easy to move between coins with the exchanges, it just racks up without people even realizing. This is really unique to crypto because you can move from Bitcoin to Ethereum, and sometimes even you can be paying fees in a third currency, which is a little bit too complicated for this video. But this is very different to shares, for instance. You can't go and buy Apple shares with your Tesla shares. You have to go, Tesla back to Australian dollars and then go and buy the Apple shares. So it's a multi-step process, whereas crypto kind of cuts out that middle step, which is why so many more transactions happen because of the ease of it. Now, in this situation, we'd be left with a capital gain. If we had made a loss, say the Bitcoin price had moved below what we paid for it, then we would have a capital loss. Now, one thing to keep in mind is that you can only offset capital losses against other gains. You can't offset capital losses against your other income, such as your employment income. So if you've got capital losses and there's no other gains to offset against in that year, that capital loss will be rolled forward to a future year. Now, do remember, if you do hold any of these for over 12 months, you will get a 50% discount if you're an individual. So in our case there, where we've got the $10,000 gain, if we'd held this for over 12 months, then that gain would be cut in half and it would only be $5,000 that would get added to our taxable income. And again, it'll be taxed at the marginal rate that you're on. Now let's talk about crypto income events. And first we'll talk about staking. So if you are participating in crypto staking and you're receiving a staking reward, this is another taxing event. Now, instead of this being under the capital gains method, this is ordinary income. Now, where it gets confusing is there is a capital gains event, then when you go and dispose of that staking reward at a future date, which we'll get to in a minute. So let's use an example here. We've got 5,000 of coin A that we paid $2 each for, so $10,000 in total, and we've decided to stake it. Now, as a staking reward, we're going to receive 100 of coin A a few weeks later. Now, we're going to assume the price is still $2 each. So we've received 100 of coin A, which is currently worth $200, and this is the accessible income to us. This $200 is ordinary income to you. It is a reward that you've received. Very similar to how bank interest is taxed to you or how dividends are taxed to you. You've now got income that is going to go into your tax return and then be taxed at marginal rates. So in total, we now have 5,100 of that coin. The 5,000 we purchased initially, plus the 100 that we got from the staking reward. Now say in the future we decide to sell that 5,100 and we get $11,000 for it in total. We have to work out a capital gain now. We've actually got two capital gains within that because we've got the capital gain on the initial 5,000 coins we purchased and we also have the capital gain on the extra 100. So to work out our cost base, we can take the cost we paid for the initial coins, which was $10,000. Now to work out the cost base for the 100 coins that we received as a reward, we simply take that income amount from earlier, the value at the time we received them, which was $200. So our total cost base is $10,200. If we're selling for $11,000, we have an $800 capital gain. So if we look at an overall point of view, we really made $11,000 in total. That was our total sale. We only ever paid $10,000 for these coins because we obviously didn't pay anything for the staking reward. That was our reward for staking. So we really made $1,000 of gains in total. But this was split into two taxing points. We had the $200 of assessable income at the time that we received the staking reward, and then an $800 capital gain in the future. So we're not getting double taxed as such, we're just getting taxed at two different points. Now you do need to be really careful in this area because ordinary income and capital gains are not the same. If you make a capital loss, you can't offset this against ordinary income. So for instance, if you receive that $200 staking reward, you've got $200 of ordinary income. If you then go and sell it for $100, you've got a $100 capital loss, but we can't offset those two. The capital loss can only be offset against other capital gains. So if you don't have any, you could be in the situation where you've got $200 of taxable income, even though you've only made $100 overall. Now let's look at crypto airdrops, and there are two different types of airdrops. There are what they call established token airdrops, as you'll see here from the ATO, which they're treated very similar to staking rewards. So if you receive an established token airdrop, and that might be you hold coin A, and as a result of holding coin A, you get another bit of coin A each month. They will be treated the same way as staking rewards that happens. We've got the accessible income portion, they form the cost base, and then when we sell, we've got a capital gains event. The other types of airdrops, which become quite common in 2021 and 2022, and the ATO put something out that was a bit more favorable for people, were initial allocation airdrops. And this is where you just received an airdrop of something new that you got for participating in something, for instance, that you didn't even know it was going to happen. They just airdropped it to everyone to kind of kickstart a particular project. Now, these are taxed differently. These have no taxing point when you receive them, but they have $0 cost base. So when you go and dispose of these assets, that is when the taxing event happens. So if you receive 1,000 of coin B, for instance, and it was initial allocation airdrop, it'll have $0 cost base, and you go and sell it for $5,000, you'll have a $5,000 capital gain there because you've sold it for $5,000 with no cost base. Now, before I get into talking about NFTs and the personal use method, make sure you've hit that subscribe button because I'm trying to get to 10,000 subscribers before the end of the year. I'm dropping a range of tax-related videos as we're getting into tax time. So hopefully if you hit that subscribe button, you'll learn a thing or two and help maximize your tax return in 2023. Now let's look at NFTs. So NFTs are taxed in a similar way to what crypto is. Pretty much the ATO's current point of view is that NFTs are the same as crypto coins. So if you're selling one NFT and buying another, that is a taxing event because you've disposed of the NFT A and you've bought NFT B. So this is something to keep in mind if you're going to be trading NFTs regularly and switching and maybe doing deals with other people, is that you're going to be assessed at the market value of the time you dispose. Now, it can get a lot more complex with NFTs because if you go and switch NFT 1 for NFT 2, and that's a trade between two people, it can be a lot harder to determine market value because we can't just look up a coin market value like we do for regular coins. So you need to be really on top of your record keeping when it comes to NFTs. So make sure you're using some kind of software, which I'm going to talk about a bit later, to really make sure that you know exactly what's happening. Now, NFTs can be way more complex because they can take multiple forms. We have gaming NFTs. We have NFTs that give you different privileges such as access to events. We have potentially just pure art. There's a lot of different types of NFTs. And I'd really advise, especially if you're using large values, to have a chat to a tax agent or an accountant or even the ATO themselves about how a particular NFT may be taxed. The chances are, the answers are probably going to be pretty blurry in this area still, And I think there's a lot of law that needs to develop to make it really clear on how different types of NFTs are taxed. At a basic level though, just think of them similar to crypto coins, that when you buy them, that'll be the cost base. When you sell, you'll have a capital gains event and all the normal capital gains rules will apply from there. The personal use method is one that popped up a lot a few years ago because it was something the ATO put on their website, and it made a lot of people think that their crypto gains will be tax-free. I'm sorry to be the bearer of bad news, but this very rarely applies. I've worked with hundreds of clients when it comes to crypto, and I've honestly very rarely seen this apply. The personal use method is stating that if you use your crypto for personal use reasons, then it is non-taxable. But the issue with this is that you have to acquire the crypto with the intention to use it for personal use reasons. And this is where a lot of it falls apart. It goes down to your intentions when you acquire. So if I go and buy some Bitcoin today because I want to buy a video game that can only be purchased through Bitcoin, and I buy it the same day or the next day, that is the personal use method. I've acquired the crypto purely for a personal use reason. Now, if I bought some Bitcoin 5 years ago and it's gone up dramatically in price, and now I go and buy something with it, such as a game, or maybe I pay one of my bills, this isn't personal use. My intentions at the time were for an investment. They weren't to spend it personally, and therefore I will pay tax on the capital gains. So the personal use method only implies if that was your intention at the time. It's likely going to be a short period of time that you've held it for, which means the gains may be really small anyway, and it has to be under $10,000 when you first acquired it. It is really a very specific area, and I don't think it applies in 99.9% of cases, but it is something to keep in mind just in case, especially if crypto becomes more adopted as a currency rather than as an investment. Now, I've obviously told you there's so many transactions. What do you do? How do you actually track all this? Well, the great thing is there is lots of crypto tax softwares out there. I've done a lot of videos on them. Go and check out my one where I rank the top crypto tax softwares. But I highly recommend you get onto this from day one of your investing. And if you've already started investing, the best time, if it wasn't day one, is today. Get onto some kind of software and put in plan of place on how are you going to track all of these transactions. Especially if you start to dive into the world of DeFi, which we've barely even touched here, or you're starting to do a lot of little trades between coins, you really need a way to track all of this on an ongoing basis. So one, you can comply with tax laws, but two, you can understand where you're actually at. I talked about this on another video, how I saved a client $94,000 in tax just by them having a look at their crypto tax software, understanding where they're at, and making some key decisions before the 30th of June. The world of crypto tax is a very complicated one. It's an ever-evolving one, and I've done a lot of videos on this topic. So make sure you go and check some of them out if you're wanting to dive further into some of these topics I've discussed today, or some that I haven't even had the time to cover. I appreciate watching, and I'll see you over there.